Well, there, John, today we are going to be diving into a great conversation around joint venture agreements, joint venture partners, and all kinds of collaborative types of investments. A lot of people reach out to us. Sometimes they're interested in trying to figure out if they can JV with us, if we know of those out there looking for JVs. And honestly, it is such a great opportunity out there that people have, especially when you're getting started in this world. And I'm going to say it's probably going to be in more the alternative asset space. A lot of times this comes up in real estate, but it also comes up in business, right? Where you might have certain skills or maybe certain assets that can help do some things, but maybe you're missing other pieces. Maybe there's learning to be done. Maybe experience is holding you back. And ultimately, at the end of the day, when you arrange a joint venture, you're really coming together to collaboratively work towards some sort of greater good, right? And a lot of times in investment, that means, growing your capital, growing your investment, and of course, having a positive outcome from that. But John, I got to say, when people are talking about joint ventures, this can be a bit of a tricky situation. And today we're going to talk about how it gets maybe even trickier than you might have expected.
Yeah. Yeah. You know, in the simplest terms, if you think about joint ventures, if you've ever watched Dragon's Den or Shark Tank, like those guys are pitching those folks on those panels to become joint venture partners. They want to kind of have those investors who come and bring more to the table than just, let's say, money. And that's usually what they're after when they are pitching, is going, hey, you've got money to invest in my company. But they also are looking for their expertise. And so when you're looking at a joint venture or having a joint venture, that you have to consider, like what Kyle was saying, you have to consider, like, what is it that you're looking for in terms of this partner? Now, also, you might be going into a joint venture being, playing one of the roles of, let's say, those Shark Tank people, and you're bringing this thing to the deal. Like, you didn't find the deal, you didn't structure it, or you didn't, you're bringing your expertise to the deal, or maybe your money. Like, for example, when I first invested in real estate, Kyle and his other partner, Matt, who was a co-host of this show for a year, they were already successfully investing in real estate in our area. And I joint ventured with them. And I didn't have the expertise of knowing, how to manage property managers, how to buy, real estate properties, and get into that world. I was the money partner. I brought the down payment. I brought the capital invested into that. They brought the expertise. We joint ventured and co-owned that property, and we still co-own that property together in that partnership. But we both had specific roles that we drew up to say, I was bringing the capital, they were bringing the expertise. Boom, that's a partnership. So that was a JV. That's one example. But basically, in a sense, you're looking at strategic partnerships. And sometimes, you have to consider, what is the partnership bringing, to this deal? And sometimes you might start wondering, is this partnership worth it, worth the deal, worth, the expertise? We always like to think about it in terms of businesses that we look at or invest in or create. When we go to reach out to people, we're like, how do we create a strategic partnership? Because anyone can bring money. But what else can we get with, say, that capital investment?
Yeah. And, one of the things that I think can be really difficult when you are exploring joint venture opportunities is deciding where that value lies. And I think one of the most undervalued is time. And expertise is also very, very difficult to measure as well. So the reality is while on this show, the easy JV split is oftentimes 50-50, but sometimes it could be even more 60% for, say, managing partners versus 40% for the money partners. And you'll notice that these can swing depending on the situation and depending on the actual roles, as John had mentioned. Are you going to be completely silent? Also, let's put it this way. If the people, we'll call it the managing partners, the people bringing the idea, idea, the deal, if it's real estate, maybe bringing the actual property to the table. If they're in a position where they have the capital themselves to go all in, they might push the envelope on what it is that they want from a partnership. So they might push more towards having more of a majority ownership because they're thinking, listen, we have the capital and we have the expertise. So if we're going to share this, we really want to make this worth our time and our effort, right? Because there's added complexity as soon as a joint venture actually happens. But rather than us going down the rabbit hole and describing joint ventures in detail, today we wanted to bring something up to your attention that you might be missing when you're thinking about joint ventures, is that everything we do in our lives, we have a joint venture partner that you actually never asked for. And that joint venture partner is the government. So I think back to how many times in joint venture situations, especially early in my journey, where when I was the money partner, where I didn't bring the expertise or I didn't, maybe bring the deal, where I used to wonder and I used to think to myself, I wish I could get more of a split. Like I want more equity by bringing the money, for example. The part that I often ignored, and I did this for a really long time, was actually ignoring the invisible, the most silent of JV partners until about April, right? Because April every year, we have to file our taxes. The government is a forced joint venture partner. And so what we wanted to discuss here today is sometimes thinking about how much time and effort we focus on things like the joint venture split or the agreement that you might be doing when you're going into an investment, and starting to think about the actual split that's happening in the background that you may or may not be unknowingly agreeing to based on how you've been structured.
For sure.
And for us, that was a massive wake-up call because for many years, we basically did deals, we made investments, whether they were joint venture or otherwise, and we just learned about the tax consequence afterwards. And what we're trying to articulate here is that actually by being smarter with the invisible joint venture partner, by actually understanding how we are taxed and how we can potentially be taxed differently depending on how we structure our deals moving forward, we could actually have a much greater outcome by doing that, keeping more money in our pocket than, let's say, trying to pull the extra percentage points from the JV partner that we're looking to get into a real estate or investment deal with.
Sure, for sure. And not even thinking about the JV partner, if you're going into a JV partner, like you said, it's everything. So like when you're looking at negotiating or kind of thinking about the interest rate on an investment, or let's say you're negotiating with the bank, who would then be a JV partner if they're giving you, say, any sort of loan or capital that you have access to, or equity in your home, like a HELOC. Like we tend to, like you're saying, fixate on the best rate or the terms of this deal without really considering that we could be optimizing on the tax side, and that would save us so much more money in the long run versus saying the 1%, 2% on, let's say, you're renegotiating your HELOC or your mortgage, when it comes up for renewal to get more access to your equity, or thinking about the interest rate or the return rate on an investment. It was like 1%, 2% when you're trying to make a deal. Like by optimizing on the back end on your tax side, you can open up so much more possibility of thinking about what that actual return is if you can structure your tax situation to be more advantageous than what you've had in the past.
Yeah, absolutely. And, so what we'd like you to be doing today as you listen to this episode is sort of pausing for a moment. And we want you to think about your own situation. Think about where income is coming to you personally, maybe where income's coming into your corporation if you have a corporate structure. And then really pausing for a second to try to think to yourself, do I understand how the money is being taxed now, and how it will be taxed if I want to access it at a personal level later. So some common examples is really understanding how is, say, your RRSP going to be taxed, right? How will your unregistered accounts be taxed? So for example, I was just on a forum recently and there was a big argument about which savings account, which high yield savings account people should have their emergency funds in. And there's people with $50,000, some have $100,000 of emergency funds that are in an unregistered, because, and I would argue as well, I don't want to take up my tax-free savings account room for an emergency fund earning 4-ish%, but they're arguing about whether you're earning 4% or whether you're earning 3.75%. And in reality, depending on the tax bracket that you are in, those 4 or 3.75% are going to be taxed because they're in an unregistered account. And therefore, if you are in a 50% tax bracket or your marginal rate's 50%, you're losing half of that anyway to taxation. So the real question becomes is when we're taking action and when we're splitting hairs over the extra couple percentage points in that JV deal, or whether it's the extra percentage point or so inside of a high yield savings account, or it might even be in my investment accounts inside an RRSP or maybe an unregistered account, we really have to look at the big picture and think about how is my invisible JV partner going to be compensated in this situation? And is this the best joint venture that I have for me? And the beautiful part is that you don't need the other partner to agree with you. The rules are set.
Right.
You get to decide, but the part that you need to know is how does it work? How will I be taxed? If I'm getting interest or I'm getting dividends, am I taking that as personal income, or is that inside of a registered account so that I don't get taxed in a specific tax year? Maybe you want that dividend income to be a part of your personal tax so that you don't have to sell off assets and pay capital gains taxes in order to live your lifestyle. But ultimately, at the end of the day, when you're looking at all of the opportunities that you have in front of you, instead of thinking about which is going to grow the most or give me the greatest return, we have to start thinking about how much of that am I going to keep in my own pocket? Because that joint venture partner has set all kinds of tax traps for you where you're just able to fall right into them, and it is advantageous for them. So take control of this joint venture partner that you have. They're sitting there silently waiting, and you get to decide on the terms of the joint venture agreement that you're going to make. And the reality is sometimes it could be a little bit trickier. So the question is where are you going to go in order to have that discussion, in order to learn about some of the different taxation rules and some of the ways that you might be able to get a better cut out of this joint venture partnership.
So we're going to, challenge you is you could whip out your phone right now if you're listening on your device. If you're watching us over on YouTube right now, you on the sidebar you're going to see other episodes that we have released. This is the point of the Canadian Wealth Secrets podcast, is to help you navigate this joint venture this joint venture partner you're on or you have, and how you can say optimize it. So if you're on your device, you're scrolling through the episodes and going, which episode is actually going to help me navigate this joint venture a little bit better? Is it going to be like episode 92 that says, do you have a retirement plan or a retirement prayer? Is it going to be, you're scrolling through and you're going like, maybe it's the 3 reasons the wealthy avoid paying down debt, and that's going to help, you navigate your tax situation. Or maybe it's about your RSP investments and the alternatives that you could be using to mitigate, say, this tax implication that you have. There are numbers of episodes by scrolling and looking in the catalog to see which episode will, be most appropriate for you to listen to. And this is the actual way that we would encourage you to listen to past episodes, is to not say listen to them in order, listen to them by area of need or which one is speaking directly to you. But that's the next step you're going to want to take after listening to this episode is going, I know I have a JV JV partner that I can't kick to the curb, but I do want to make sure that I can structure this to be advantageous for myself, my family, other business partners that I have.
And if you think about this and go, if I can keep more of the money that I earn, regardless of how I earn it, whether it's a T4 income, whether it's a dividend from my own company, whether it's some other way, however you're earning income, and how you're going to set yourself up to earn that income into the future is going to make a bigger impact on the net or end result than, say, the actual investment you make, right? Taking that, having more money to put into your future wealth is going to be a bigger payoff, especially if we put them into buckets that are going to allow me to then take more of that earned income and keep it in my own pocket. So thinking a little bit different than maybe how we were all raised, how we thought about investing in school. We have to start thinking about, how do I keep more of my money now from that JV partner? How do I grow it from here in buckets? And when I say buckets, it's in assets, in buckets, in accounts that are going to be advantageous for me later when I follow through on my plan to utilize those assets for my own income. How can I do it in the most tax efficient way so that that JV partner gets their true fair share? Not what they believe is their fair share, which is the maximum amount they can receive, but the minimum amount they can receive, so that you are on the upper or have the upper hand with the assets that you've accumulated. So folks, check out those episodes. Just like John said, give it a scroll, and we would love to hear from you. What is your situation? Send us an email at kyle@canadianwealthsecrets.com and reach out to us. Let us know where you're at. Where's your biggest hidden JV partner challenge? And we'll do our best to provide you with some guidance and next steps. As always, you can head to canadianwealthsecrets.com/discovery, and you can book yourself a discovery call. And we'll go through your scenario and try to give you your very next step towards building that wealth that you're after for financial freedom and to try to silence that JV partner.